And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for one of our now regular live reaction videos to the today's Federal Reserve announcement and latest FOMC release and Jerome Powell presser. I am joined as usual by just fund manager extraordinaire and Fed-watcher Axel Merk. Axel, how are you?
Great to be with you. Always good when I talk to you, and all fired up from from the summary of the debating club that matters to all of us.
Yeah, well, you're very kind. We're both a bit of under the gun here time-wise, so we'll try to get as much packed into the hour as we can. All right, folks, so just very quickly, in case you didn't hear the news yet, the Federal Reserve cut interest rates by another 25 basis points, as expected. I would say as largely expected. The Fed also announced that it would be ending quantitative tightening, otherwise known as QT, that would start on December 1st. So I think that's the real big headlines. There were two dissenters on the rate cut decision. Sounds like on either side, one wanting 50 basis point cuts. I'm going to bet that's Moran. And then one wanted no cuts. I did get a chance this time, Axel, I've been recording all day, but I did get to actually listen to Powell's comments and listen to maybe the first half of the Q&A with the journalists. But before we get into the details of that, what are you taking away from this?
Well, you missed the good part if you missed the second half.
Oh, really? Oh, well, there we go.
Yeah, there we go. I don't know whether you left before or after when he said that a December rate cut is far from a done deal.
I did get that one.
Yeah. Yes, exactly. And then the kicker, there were a few kickers, but the one I thought was, I don't know, hilarious or whatever it is, where he said, hey, I'm just telling you what's happening in the meeting. So it wasn't that he had that in mind, that the December rate cut is not a given. But just to take a step back, this summer we got these famous dot plots where the FOMC members give their projection, and the way it is done is rather than saying over the next several months, it's grouped by calendar year. So you actually see in September what the intentions are of the members through the end of the year, because there are only 2 meetings left by the time they do this, or maybe 3. And so there's clearly a divergent camp. There are the folks who say, yep, we should cut, and the other ones say, no, maybe we should be there or even hike. And that's because, as Mr. Powell aptly says, we got inflation risk to the upside and employment risk to the downside. And one thing, if one listens carefully and wants to be a cynic, he says, okay, we'll do to support maximum sustainable employment. And then he didn't say, oh, we'll keep inflation low. No, he'll say, we'll keep inflation expectations anchored. Mm-hmm. And the reason I mentioned the word, if one wants to be a cynic, that basically means you get away with anything as long as you don't lose the credibility of the Fed, which means you might as well cut rates. And of course, you can flip this on its head and say, well, maybe they should be pursuing sound monetary policy to foster anchored inflation expectations rather than kind of pushing things in a way that you might get away with things.
Right.
And so, yes, so clearly, and we obviously had a dissent in each direction this time around, which means appears to be that the folks who say, well, maybe not so fast, maybe not so much, maybe we should take a break, they were getting a lot of airtime in that meeting.
Yeah. So, okay. So, yeah, Powell, so when pressed on now, of course, the Fed doesn't have all the data it normally has, right, because of the government shutdown. But when pressed, Powell
because
said,
then
hey,
they would be perfect in the decision making. Yes.
Right. Yeah. Exactly. But Powell said, "Hey, look, we got a lot of other data sources that kind of give us a general sense of where we are." And he said, the labor market seems to be continuing to cool, but in an orderly fashion. Nothing super concerning there. Like it's not like it's getting worse, worsening at a fast pace. So the tightrope, as you said, that the Fed is walking right now is He said the risks to inflation are to the upside, but the risks to the labor market are to the downside. And by downside, he means continued weakening there. So he's like, look, we got to kind of walk this tightrope. He did, to your point, he did go out of his way. He said, look, I always say, look, we're not going to tell you what we're going to do with rate cuts at the next meeting because we're going to look at the data. But he said, I'm going a step beyond that here. And I am telling you that it is definitely not something that people should just take as a fait accompli, another rate cut. So it was interesting that he did go that far. And I think that's why the markets have sort of softened while the Fed's been doing Q&A. Metals have come down, Bitcoin's come down, markets have cooled from their initial reaction. So, maybe this is people saying, oh, maybe we get a discount now, the fact that maybe we might not get the rate cut that we were counting on.
Yeah. So December meeting as we speak is now 67% chance of a rate cut, whereas before it was pretty much a given. So, and that will change, and we'll see. And those are shouldn't be consider these to be overly precise, but trends moving that. The one thing you said is yes, there's a weakening labor market, and he used that as quote unquote proof that the Federal Reserve is still in a tightening bias. And I paused when I heard that because I don't actually think that is correct. When you have a slowing economy, and let that be part of being a tight monetary environment, and you start lowering rates, let's say you lower rates aggressively, let's say you lower them to zero, the labor market may still continue to ease because there is, I was once taught, a long invariable rate reaction to Fed action. And and just because you cut rates, there's no guarantee the economy is going to recover. So I don't know whether you can kind of have a direct proof because that conditions are tight. And the reason I say that is we today, as we talk, we had the first $5 trillion company this morning happening, and there are clearly some AI stocks that have been on fire. Quote unquote, everything is up. I mean, not exactly, but a lot of things have been up. Is that really a tight environment? And the other part, I'm sure we're going to get to it. They're gonna phase out in December the shrinking of the balance sheet. But he used the argument he gave is that there are some issues in the funding market, and that's again proof that financial conditions are tight, and that is completely wrong in my view. Yes, what that proves is that paying interest on reserves with a broad brush has significant shortcomings, because just for context, for those who are not kind of nerds to look into these sort of things, the Federal Reserve used to intervene in the Treasury market to keep rates where they're supposed to be by buying and selling Treasury securities, and participants would bid for it and get their funding in the overnight market done. And the Fed said, that's all too complicated. We'll just pay interest on the reserves and everybody is happy. The theory of that works. There's various problems with it. One of them is political, because the Fed is literally paying billions to banks for doing nothing, for parking money with them. But more importantly, there is such an array of regulatory frameworks that affects different participants in these markets that the funding environment is a tad different in the different players. And rather than allowing the market to fine-tune that, there's this broad brush paying interest on reserves. And what you end up doing is you're providing a funding environment for the weakest of those players, so that there is no tension. But it means almost by definition that you have very generous funding certainly for the average, if not for the vast majority of participants.
Right.
So I'm wondering, and of course, let's think about it. This entire framework was introduced after the financial crisis, And ever since the financial crisis, the problem had been, oh my God, inflation isn't high enough, growth isn't high enough. And so finally, we're in an advanced stage where, for better or worse, right, we had a bout of inflation. We have an economy that appears to want to grow in some directions. You got to wonder whether they have the right framework to control where the economy is supposed to be, because with the current framework, there is no more this thing that you have required and excess reserves. There's ample reserves. This economy can grow if it wants to grow. And so the Fed has kind of boxed itself in. But you tell me whether we have a tight environment with reaching record highs in different parts of the markets and whatnot, with being ample funding available for anything that has AI in the name. Wall Street Journal had a story that there was a 10 billion valuation for a private company, and all they appear to be doing is have people record voices for ChatGPT, and they're getting a cut of that. I mean, it's great for them, but I am questioning whether this funding environment is really so tight if that sort of stuff happens.
Yeah, and as you know, Axel, we just had the Thoughtful Money Follow-on Conference, and we had Michael Howell present there, and his big focus is liquidity. And while he does think, in terms of the grand liquidity cycle, that'll be peaking by the end of the year, beginning of next year, he does not see a receding of liquidity yet. And I think he would agree with you that, hey, this does not seem like a very tight environment.
And neither do we. We don't. I wasn't part of that presentation, but we have our own liquidity monitors, and no, liquidity is not tight.
Yeah. So what's interesting about this, and you just gave a note to it, but I had a note here to really get into it with you, is we are starting to see early signs of stress in the credit markets. Right, we're starting to see more usage of the Fed's overnight repo market. We're starting to see credit spreads start to at least show some life again. They're not just tabletop flat anymore. We have seen some of these cockroach companies, all of a sudden roll over and die. And to your point, like we're seeing that when liquidity seems pretty ample, right? So it kind of begs the question, stock market at all-time highs, liquidity ample. Like these are the good times, and yet we're starting to see stress. Not terrible stresses yet, but initial signs of stress, such that the Fed may say, "Hey, you know what? We got to, change tack next month." So anyways, it's to me, that's just one of the things about here that just sort of is sounding a sour note, which is just like, wow, should we really be starting to see signs of stress when things are still, as awesome as they apparently are?
Well, one example I like to give is that it is different this time. The reason why I actually believe that, what is different is that the Fed, every cycle we seem to be going through, is ever more micromanaging the economy. Mm-hmm. And indeed, Ben Bernanke wrote a book during COVID where he considers that a feature rather than a bug, that they can manage the business cycle. And the example that I think everybody remembers is after the failure of Silicon Valley Bank, it suddenly occurred to the regulators that banks had been mismanaging interest rate risk. And the Fed said, oh, never mind, we'll throw you a lifeline and everybody's going to live happily ever after. And that was a big reason why this recession that everybody said is going to happen never came. Because when you kind of put out every fire that comes, we'll live another day. But that doesn't change the fact, of course, that this economy has been very, very extended. And so you talk about cockroaches falling over dead, right? That's the sort of stuff that should be happening at this stage. I mean, you can argue that, of course, yes, expansions don't die of old age. Yes, there will be something else that does it, but we also have consumers that are weakening, not broadly in all measures, but in auto loans, which is kind of a canary in the coal mine. And just then on auto loans, why that is particularly sensitive maybe is during COVID, when everybody, in quotes, got subsidy, the FICO scores improved. And so people were able to get more credit than they might have otherwise. And apparently they splurged on cars and other things. But because their budgets are stretched, they're buying used cars that are ever older, which means you have maintenance costs. Insurance rates have gone up. And so it's just very, very expensive to own a car. And I certainly see it in our household. I presume you do, and most of the viewers as well, that insurance, maintenance of stuff, all that stuff has exploded in cost.
Mm-hmm.
And I'm in the lucky situation that I can afford it, but I trust not everybody is, right? And so you got to have some cuts somewhere. And at the same time, the economic measures are ever more influenced by the top spenders, because the bottom portion, kind of, they are just trying to get by, and they buy the basic necessities, and there isn't as much variability in a recession in that.
So let me just interject for a second, because that was the last question that I got to in the Q&A, where I don't know if they asked him about it directly or if Powell just brought it up, but they were talking about the K-shaped economy, and Powell said, "Yeah, we're familiar with this whole thing of the K-shaped economy, and we, from what we hear when we talk to corporate executives, it seems to be a real thing where the bottom half of the economy of society is struggling right now, but the more affluent top half of the K is out there spending, and they're kind of keeping things on average okay, right?" But Powell concluded by saying, "But we think there's something there," and then he moved on to the next question. And I'm thinking, like,
yeah, well,
are you kidding me? Like, a huge reason why we have this K-shaped economy is because of policies that you guys have been pursuing.
Yes. Well, there are two things to it, right? On the one hand, yes, the pushing inflation increases the wealth gap. Low interest rates push up home prices, make them less affordable. At the other end of the spectrum,
well, but just be clear, low interest rates raise all asset prices, meaning those who have assets do great.
If you have assets, yes.
If you have assets, yeah, which the
exactly.
minority has, yeah.
Exactly. But at the other end of the spectrum, it is not the Fed's job to deal with income distribution. And I'm not saying that's why they should have been doing these things, but it is not appropriate for him to say, "Oh yeah, we'll do policy to kind of," and he used to do that very actively, has done much less of that in the current political environment.
And I totally agree with that, but you got to be cognizant then when your policy does exacerbate it, right? It's not his job to manage it, but it's not his job to make it worse either.
And of course, I mean, one of the Fed candidates we have been talking about with you extensively is Kevin Warsh, who has been a critic of this, not just recently when he's becoming the potential next Fed chair as a candidate for it, but has very, very actively talked about this over the years. So he is one of the few credible voices of that who might go on the Fed and says Fed needs to get out of all this business. And so it needs to be credible. And I had the good fortune, I actually met both Kevins, both Fed candidates, both Kevin Warsh and Kevin Hassett at a conference the other day. And the conversations were all offline, so I can't talk about those specifically, but they didn't really say anything they don't say in public. But it was interesting to see the two candidates there at the same time. And Kevin Warsh has kind of really honed in on this message about how the current Fed has kind of failed in its mandate, and there needs to be some deeper reform. And we haven't talked much about, right? We don't have all these data right now, but there's really much more to it than the data. There's a communication strategy. There is the Fed balance sheet. There's all kinds of stuff where the Federal Reserve has done things that they shouldn't be in. The Fed needs to get out of politics and needs to focus on its job and needs to be credible at its job. And especially when you're towards the end of your tenure, credibility and leadership matters. But I allege that Powell has never had intellectual leadership. Right? It's always been this debating club. And now we see a revolt happening, right? People dissenting on both ends. And he says, well, maybe the rate cut I want to have in December is not going to happen. And by the way, it depends on how you look at this market. whether you think it's more supply issue or more demand issue, it's presumably both. But Powell says he's in the demand camp, and therefore he wants to cut rates. I'm not putting too many words in his mouth because he pretty much said as much. But there are clearly others at the Fed who are concerned about taking rates too low at the current stage, with inflation as high as it is.
Yeah. And so just let's talk about inflation for a second. So Powell said that inflation is kind of it's bifurcated right now, where he says we're now seeing goods inflation, and interesting because goods had been deflating for a good chunk of the past year and a half or so. But he said, goods are inflating, and he said that's due to tariffs. And he said services are disinflating, which, is those horses have shifted, because for much of the past year and a half, it was services that were continuing to inflate while goods were deflating, but the services market is bigger. And so therefore that was pulling, it was net inflationary. So I guess just to take a pause here for a second, but Axel, what do you think, as best you can tell right now from the inflationary data that we know of, is it more likely to continue disinflating from here because of disinflation in services, or will tariffs be more and more felt, and might that actually take the lead horse here?
Well, the short answer is we truly don't know. And part of it is because not the data just so messed up, but economic activity as well. When you hear from the executive that tariffs are on, tariffs are off, tariffs are on, tariffs are off, the one thing you're going to do is you're going to try to control what you can control, which is you're going to contain your cost, and you might want to move up your purchases. And so we see a lot of anecdotal evidence that people are doing now still purchases that they might otherwise only do in the springtime to get the inventory in, because you just don't know what the policy is going to be.
Yep.
At the same time, we see all these layoffs happening, and people blame AI, and AI almost certainly is a contributing factor. But I think fundamentally it is that companies, with everything that's happening, say, well, we don't know what the future is going to look like, right? They don't know more than you or I do, and we look at this stuff quite intently. And so they say, well, the one thing we can do is I think we can do with 10% less of our workforce.
Right.
So let's cut our costs to be ready for whatever might be coming.
Right. We can err on the side of conservatism.
Yeah. And so if you play this through, the rational development is that at some point you will have bought everything you want to buy, and you're going to have to slump at some point. But that's just the theory. In practice, a lot of other things. I mean, we haven't talked about deregulation. I mean, the current administration is throwing a lot of weight at deregulating things. And when you go into rebuilding infrastructure and reshoring, a lot of these things take a while. And so,
right.
But at the same time, when we hear headlines, oh, this country is going to invest these many billions, well, is it just a headline and no follow-up, or will there be follow-up? And so how that exactly plays out remains to be seen. What we can see is that the low-end consumer is weaker. The high-end consumer may well be quite dependent on asset prices. And so if you're going to tell me that the stock market is going to go up 20% over the year, we'll probably have an expansion. If you tell me the stock market is going to get down 20% over the next year, we may well have a recession.
So I'm just curious on that point. It's looking like we're going to have our third back-to-back year of double-digit returns in the stock market.
Well, I don't know. It's depending on which market you're in, but we have 29th of October. We don't have the 31st of December. Let's talk at noon on the 31st of December.
But let's just assume, let's just assume that we're hovering around S&P 7,000 by the end of the year. How likely is it we'll have a fourth year of powerful returns?
Well, the only thing we know is that usually what we think is the most important thing for the following year is not the most important thing, right? All this procrastination is almost certainly wrong. So it is the unknown that's going to get us, either on the positive side or on the negative side. As you know, and many in the audience know, right? We manage over $3 billion in gold and gold mining. Obviously, it been a tremendous year.
Oh my God! Is it $3 billion now? It's amazing what 40% increase in gold will do for you.
It depends on the day you talk to, but we hit 3.5 billion just before the sell-off, and it's it was 2 billion in the springtime, and about 1.5 billion about 13, 14 months ago.
Yeah.
And so that just shows you the sort of environment that's happening. And we do physical gold. We also do the gold miners. The gold miners obviously have been somewhat on fire. And by the way, I'm not giving investment advice here, just to make that clear. I'm just mentioning those things to give you an indication that these market dynamics have been quite extraordinary. Now, historically, when we do very well, the rest of the market doesn't. And I joke when I want to splurge and buy a car or this or that. Historically, when the price of gold is very high, I have much more negotiating power because other buyers are not there. Whereas currently there is some weakness there, and especially now, next week there's going to be an election, and some people are worried. Not that it's going to make a huge difference, but that usually gives a little bit of a vacuum. But for the most part, the traditional equity investor is doing quite well. And Powell was asked whether he's concerned about the stock market, and of course he gave the only right answer: is the Fed's job is not to manage asset prices, but the Fed's job is to think about credit conditions. And the framework that he applied to this meeting is not particularly impressive. And by saying that, oh yeah, well, in the funding market, interest of reserves, you might have to stop QT, and that's proof that conditions are tight, type of thing. And of course he knows other metrics as well, but it does matter what he communicates, because the market will look at what sort of bias he has. And but he said as much, right? He has an easing bias, but the rest of his team doesn't. And so he may or may not be able to push through a cut next time.
Okay. All right. Well, let's see here, folks. This is live, so I will be taking questions from the live chat. So as you have questions for Axel, feel free to ask them there. You mentioned you met both Kevin Warsh and Kevin Hastert. As an FYI, Axel, Judy Shelton was participating in our conference as well, and I asked her, who would you like to see? And I've talked to her in the past before, and I know she
would like to see herself.
Pardon me? Well, no.
But
I know she thinks very highly of Kevin Warsh, but she said, I really like Hastert. And I'm curious, you and I have talked more about Warsh than Hastert. Do you have anything to say to the audience here about your perceptions of Hastert and what he cares about?
Yeah. So Hassett.
Hassett.
Well, again, I can't talk about the specific conversations I had with them, but all the folks who are the final round candidates have a very good set of qualifications, kind of just based on paper, but they're very, very different. And the reason why I've been talking up Kevin Warsh is because he's the real deal in terms of reform within the system. Mm-hmm. Obviously, I mean, Judy Shelton, she has some great ideas, but they're not going to get implemented. And indeed, her nomination failed, right? Kevin Warsh, having been a Fed governor and has talked about, he resigned. He was part of helping get the economy through the financial crisis. But he also said he's only okay with QE as an extremely short-term measure, and then he resigned as a Fed governor out of protest that it continued. So he said this is only an extreme emergency, and you cannot have that the Fed buys bonds. And so he's been very consistent also on communication strategy. We've been talking about you can't do forward guidance and so forth. And so he wants to do a deep structural reform on the Fed within the confines of the existing law. Mm-hmm. And so he has a bit of a reputation of being hawkish, but in the current environment, by the way, his view is that the way to get through the debt that we have is through a productivity boost. But the most important thing is that the Fed is credible, and he has a bunch of ideas to do that. The other Kevin Hassett, he's obviously head of the Council of National Economic Council, and the the risk is that the market perceives that as a political choice, and perception matters, right? He may be perfectly qualified, and personality-wise he's different, but a very pleasant person. A pleasant person doesn't make you a good Fed chair necessarily, but the perception may be that he is going to be pursuing the government's agenda.
That he's a Trump puppet, yeah.
Exactly. And even though he is his own person and will do his own thing, that perception is a risk. And then you have other candidates like Michelle Bowman, who is a Trump appointee, but on the Fed governor board, very qualified, or Chris Waller for that matter. I mean, Chris Waller, who has been in the news a lot, Chris Waller has a very good instinct, historically speaking. He is warned about the inflation, and then he's been willing to do U-turn. He's willing to adjust. But if we get him, I am certain we will have the same conversations as we're having now, because he is so much of a team player that he is not going to change the way that the Fed operates, right? He also likes to do forward guidance a little bit. He may be setting an appropriate interest rate. I have no doubt about that, but he will be somebody who's not going to change structurally what the Fed is doing, which means he's going to continue, or the Fed is going to continue to be the punching bag of the administration, and all the criticism that's there is not going to go away. Maybe in the short term, if we cuts rates faster, right? And so all these people can do the job within that framework. Kevin Walsh is the one who kind of says reform. We need to reform, but we need to do it in a prudent way. And I happen to agree with those the big picture issues that he's talking about.
You know, what's interesting is the other person who talks a lot about the need for reform at the Fed is Treasury Secretary Scott Bessent, who was kind of leading the talent hunt for Powell's replacement. Do you think Walsh has an inside track as a result?
Well, they all know each other. They're all buddies, right? I mean, so that they get Hassett, of course, as well, right? And Bessent, of course, is a candidate as well. He says he's not, but who knows? Similarly, he might be considered a political choice, right? If he gets it, and there's no need for him to get it, then they might as well use Kevin Hassett rather than Bessent. I think that's from administration's point of view. I think that's the smarter choice. But it's by the way, Hassett is the one guy who's not a billionaire in that clan, and so he has a normal income and a normal savings. So he's the most normal of the very top contenders, and so that in the Trump world that might make a difference. I don't know.
Well, you know, it's so interesting too, in the world in which we're entering. You know, it's almost like there's an appeal for somebody to be so wealthy that they don't have to toe a line because their job depends on it. You know, I'm not for a government of the oligarchs by any stretch, but I think that's some of the appeal that people have for the Trumps and Bessents and Musks of the world, that they're like, hey, these guys are able just to do what they feel is the right thing to do.
And they're outspoken, right? And they do it because, I mean, obviously they have an agenda, and obviously half the country, plus or minus, will disagree with whatever they're saying. But yes, they're motivated, and they can afford to serve. And it's
and importantly, on the flip side, you know, people are seeing folks like Bernanke and Yellen go from having just been kind of academics who made, you know, a livable salary, to all of a sudden getting, you know, board seats at Citadel and getting paid, you know, $1 million a speech. And so there's a sense that, like, if you're not independently wealthy and you're sitting in one of these government positions of power, that you're getting influenced by these deep pockets who are promising you riches after your tenure's over.
Yes, although, I mean, there are plenty I have to criticize about both Yellen and Bernanke. I don't think they used their jobs as jumping boards with intent to get rich and so forth. You see that in other corners, and that risk is, of course, there in government in general. But they both also today, they're not abusing their their situation and so forth. So in their defense, but yes, it does. It does. If they're independently wealthy, that then you say, well, why are they doing this? And those who are favorably inclined say, well, they just do it because they have a calling. And just kind of broader context, I have gotten to know several of the Fed presidents over the years, some of the governors and whatnot, and they're all serving with the best of intentions. I mean, we are here criticizing what they do, but they have their framework. And I've said many times, right, the road to hell is paved with good intentions. And that's the, and ultimately monetary policy is hostage of fiscal policy. I mean, you talk about independence and how that's good and whatnot, but when the fiscal situation is not sustainable, at the latest with Draghi, we learned the central bank will do whatever it takes. And so that's where we are, and that's what needs to be fixed, right? But again, right, Kevin Walsh says QE enticed the government to spend lavishly. When you push interest rates down to zero and buy up all the debt that the government issues, you're telling them deficits don't matter. And so again, it's monetary policy plays a crucial role. It's ultimately politicians that make the decisions, but why shouldn't politicians use the Fed to spend more money if that bazooka is at their disposal? And so if the Fed wants to have independence, it goes both ways. The Fed needs to behave. And the Bernanke Fed, the Yellen Fed, the Powell Fed has not behaved. They have drawn politics more. And the problem is they don't get it. Right, a simple thing as paying interest on reserves is not a good, wise political choice.
It's distortive. Yeah. So let me ask you this. So, a lot of people are prognosticating on the direction of bond yields next year, and of course, the Fed is bringing down the short end of the curve, or likely to, and folks are hoping that will then transmit to the longer end of the curve. But one thing that is interesting, and I'm curious to hear your thoughts on this, is, the Fed has largely been, the Fed was the marginal buyer of US Treasury debt from 2009 to 2022, right? And then they stepped out of that market, and yields went up, not necessarily for that reason, but because of inflation and everything else as well. And the Fed has been buying some treasuries because it's been managing the decline of its balance sheet, right? And so if on any given period, more treasuries roll off than it wants to stay on its pace, it has to buy some, right? But now it's ending QT, and it's now saying, look, we're going to let the mortgage debt, the mortgage-backed securities roll off, and we're going to replace them because we're fixing the balance sheet here now at whatever it is, $6.5 trillion or whatever, right? So the Fed is actually going to be buying materially more treasury debt than it has been for the past couple of years just to keep the balance sheet flat. How much of a difference is that going to make to yields?
Well, the good news is that they're going to reduce their mortgage exposure. I have never been a fan of that. The Fed's central bank's job is monetary policy. Buying mortgage-backed security is credit policy because it's fiscal policy because you are allocating money to the mortgage sector. That is not the Fed's job. And so it's a step in the right direction. Ultimately, what will drive things is the next Fed chair, how credible the next Fed chair will be. And that's where we'll see very quickly if, let's assume Hassett is going to get it. Will the bonds sell off or not? If they sell off, then he'll be seen as a political play. If it's Kevin Walsh, he blames the Powell Fed for rates being as high as they are, saying their own projections suggest that they are not, that the FOMC has given up on 2% inflation. And he points out that 3% inflation is not 1% higher, but 50% higher. And he says that's no good. And so the question is whether he can he could give that sort of credibility as to where we need to be. There's, of course, the theory that the long-term rates are kind of a combination of what the shorter-term rates are over the long run. but there's a premium that's implicit in that. And one thing I have indicated as part of the reason the rates are higher is because of tariffs. But because tariffs don't just influence the flow of goods, they influence the flow of currency. And if we're going to have all these trade deals, maybe we'll see some smoothing in that. So that could get longer term rates to go lower. So there's a lot of ways this can go. It could go in a direction. I mean, it can only go up or down or be stable, but the driver, I think it does matter of where we'll be.
Okay, so I get all that answer. I'm just going to ask my question again, which is, with the Fed stepping now more into buying treasuries, how material a factor is that likely to be at just this replacement rate? Is it marginal, or is it pretty material?
It's marginal only because there's so much supply coming on the market. There is so much more debt that's going to be issued, so much more, and so forth. And so yes, it does have an impact, but it's
okay. But until and unless the Fed decides it wants to expand its balance sheet by buying treasuries, you think it's marginal?
Yeah. Yes, and for what it's worth, right? All this discussion only matters as long as there's confidence in the Fed. If for whatever reason confidence were lost in the Fed isn't big enough, because the credit markets are just so huge that this bazooka the Fed has is powerful, but it's not omnipotent. Right? There is, and I'm not suggesting we'll lose confidence in the Fed, but you can look at metrics in the credit markets of what the assessment is of the market. I mean, we can be critical of Fed policy, but ultimately, as long as they have the bazooka and as long as the Fed believes, that people believe they'll do the right thing, ultimately, the markets will be contained. But yes, these nuances do matter. They matter for mortgages. They matter for risk spreads. They matter for all kinds of things.
Okay, great. All right, I'm going to start getting to folks' questions here. These are not going to be in any particular order, Axel. This first one, though, I know has been, or variants of it have been getting asked a lot on this channel. I don't know if gold is returning back down to the low 3,000s, but the general question is did we just see a blow off top in gold, and pretty much is the run over and is it only down from here?
So I don't have a crystal ball. I can give you a few answers. The first answer I'll give you is that historically, speculators are an integral part of the gold investor. For several years, the speculator was absent, and that reduced volatility. The speculator is back, and that's a good reason or a big reason why the volatility has come back with a vengeance. If you can't stomach the volatility, then you might not want to be in gold, or at least not as exposed to gold as you are right now. So that's one answer. The second answer is, in the run-up to gold, the one thing I did not see was a retail frenzy, which is historically associated with the top. Retail investors were selling their gold coins, talking to wholesalers. They're not ordering from the mint because there's no demand, because the coin dealers have enough supply that they get from their customers. And so that is historically, at least, not a sign of a top. If you look at the gold mining ETFs, they've had outflows. Not been huge on the physical ETF side. The both inflows and outflows, but nothing that's historically consistent with a market top. Now, on the price action, clearly we went to the roof, right? And even a very substantial pullback would be very consistent with that. And so that's why I can't give you a prediction where it's going to be. The underlying drivers are still there, but the other thing is we're kind of having the end of the month, right? If you are an investment advisor, invest on behalf of clients, you might as well take some profits and rebalance. And one thing I've seen, many institutions have been part of that run up. With one way I like to phrase it is the fringe views of the gold bugs are moving more mainstream, and because the gold market is fairly small, it has a disproportionate impact. And one thing we see is that people that have historically had a 60-40 allocation, 60% stocks, 40% bonds, are reevaluating what they do with the bond portion. Mm-hmm. And obviously, it's not all stuffed into bonds, and gold is not a bond, and recent volatility might give some people second thoughts on that. But that doesn't mean they like bonds. And And because these things about deficits being unsustainable, that's not a secret these days. I mean, and so the question is only what people are going to do about it, and gold disproportionately benefits from that.
Yeah. Can I ask you on that? So again, at our conference a week ago, Andy Schekman, CEO of Miles Franklin, a big precious metals gold dealer, in fact, Thoughtful Money's officially endorsed precious metals provider. He went through a bunch of quotes, recent quotes from like big Wall Street brands like Morgan Stanley, Bank of America, Goldman Sachs, Jefferies. He also mentioned Jeff Goodlock, and then soon after he had made this discussion with me, I heard Ray Dalio say something very similar, and they were basically all saying, "Hey, bonds don't seem to have a great future ahead of them over the next decade, and there's lots of reasons to be looking at gold. So why not put 15%, 20%?" 25% of your portfolio in gold and take that from the traditional 40% that was bonds. Now, it would be gargantuan if that actually happened. But even if single-digit percentages of capital move from the bond market to the gold market, it would still have a huge impact on price, just given the imbalance in size between the two, at least in my opinion. Do you think we will see a continued shift of capital from bonds to precious metals?
We will see a continued shift out of bonds on an overall allocation. And gold is but one of the beneficiaries. I phrase it that way is because if you take central banks, they want to get less dependent on the dollar, but it doesn't mean they stuff all the money into gold, but some of that will go into gold, right? And you're talking to somebody who's biased in this, because I do have kind of on the higher end of that in my gold exposure. I think for investors, the way I like to frame it, and as you know, I can't give specific investment advice, but I like to look at these things in terms of risk. Can you afford to be in this asset or that asset? And the more cash flow you can generate through your job, notably, the more freedom you have to take on risk. And as a reminder, right, it's good to have the discussion after a significant kind of sell-off in gold. I talk about significant sell-off, and we're at over 3,900 on the spot price.
I know.
But volatility is something that in the abstract people don't get, but people do experience it when it then comes, right? And so if anybody listening lost sleep over any investment during the recent bout of volatility, it means you might have too much allocated to it. It applies to gold as much as to anything else. If you can afford to have a lot of gold, by all means, be my guest and have a lot of gold, right? The other thing is, of course, the one thing I like to say is you don't need to have the ideal investment strategy, but having a strategy is super helpful, because if you don't have any strategy, you're bound to lose money.
Right, you're just going blind.
Yeah, but stress test your strategy, and that implies, even when you have much more gold than the typical investor has, stress test that. Are you comfortable with that? If price of gold were to plunge, would you be okay with that? And while you and I may be thinking that the price of gold is going to go higher, there's no guarantee that will happen, right? I mean, these markets go both ways, and especially if you're a silver investor, while that has, of course, had a fantastic run, anybody who has invested in the silver in the long run knows how gut-wrenching that can be.
Yeah, you've got scars if you've been investing in it over a 5-year period. All right. Okay, I'm going to keep coming back to these questions. Axel, who has been short selling paper gold, and how much longer can they get away with it before it fails?
Well, there are plenty of industrial users and other users that short it. So the gold bug always thinks that they're special. Every paper market has a derivatives market, and there will be short sellers for all kinds of reasons, if only to provide liquidity and this and that. I think the last bit here before it fails, I think one of the noteworthy things is in this spike in volatility volatility is that these markets were behaving orderly. Let's keep in mind that there is an underlying physical market, and I've talked to some vault managers in recent weeks, and they all say that they have been working extremely hard because in the springtime, precious metals went to the US, and now it's been shipped back. I can't say that they hate silver, but silver is just volume-wise so much more for the same value. That is just an incredible amount of work. But those markets have been functioning, right? And so we always like to say, oh my God, where are these short sellers? When are they going to fail? Anything with the derivative markets is going to have some challenges at some point. But these markets have been very, very orderly in this volatility, and they're not going to go away. I mean, if it makes you happy to talk badly about the short sellers, go for it. But there are legitimate reasons why some people short it.
Well, sure. I mean, if you're a producer, it's a hedge, right? So
yeah. So it's and of course, many of the producers these days, if they are not required by their bank, the investors don't like the hedges, and so they may not be. But yes, there are reasons to hedge, and some people do it, and then some people just like to provide liquidity and hedge their way in other ways.
Okay. All right. I'm just going to let you know, Axel, we got 4 or 5 minutes left, just given our time constraints. So feel free to give just short answers to these, and we can let you riff longer on them next time if you feel like it's too unfair. This question is a little loaded. How does the destruction of the dollar play into the crypto market? But then he specifies it by saying, in the sense that stable coins are taking over where the dollar dies. I guess I just let you say whatever you want to say about stable coins.
Stable coins, I mean, to the extent they're tied to treasuries, they are tied at the hip, and so it's not like it's an added avenue for liquidity. It is fantastic news, I think, for the crypto market to have that bridge of the stable coins. A lot is happening on the regulatory side. The other part of that, on the destruction of the dollar, yes, there is an incentive to diversify out of the dollar, but there has not been a run of the dollar. We would see far more stress in the market. And the other side of that is that the run-up we've seen in precious metals, we've seen without a debasement trade in earnest. This may be the beginning of it. And we talked earlier about all asset prices up. This feels like the beginning of inflation. It's the beginning of the debasement trade. The beginning feels good because everything is doing somewhat okay. It's the advanced stages that we should be concerned about.
Yeah.
But there's a lot of skepticism in some regulators about the stable coins. I don't share them. I attended a seminar the other day, and some academics said, "Oh, this is when banks were able to issue private money." I look at it much more like money market funds, and money market funds are in that sense a private form of money, and they work perfectly fine. It doesn't mean that they aren't issued and there aren't growing pains, by all means, but part of the restriction on paying interest on many of these stable coins just means that the folks who issue them are making an absolute boatload of money right now.
Yeah, and that's actually a good way. I mean, I'm not an expert on stable coins, but the way in which they are currently sort of envisioned to come in and be big incremental new buyers of treasuries, it is like a money market fund, right? It's basically a pool of capital that is allowed to invest in treasuries, and that's about it, right?
And there will be growing pains, and maybe there will even be a blow up, but I don't think that's going to threaten the financial system or be the end of the dollar for that matter, the other way around either.
Okay. Hey, a question on that. You've probably seen the same chart I have that shows that, or showed about 2 weeks ago, that for the first time in decades, foreign central banks held more in gold than they did in U.S. treasuries. Right now, that was a market value weighted
in dollar terms, not in ounces, I don't think.
Right. No, so it was in market value, dollar market value terms, right?
Yes.
And so people have said, oh, well, look at that. That's proof that foreign central banks have stopped buying treasuries, and they're now preferring gold.
Yeah.
And I think what I've learned is that chart in particular, very driven by the price appreciation in gold, right? And if you look at the ounces bought by world central banks over the past several years, Yes, they are increasing, but not that much. So this narrative of foreign central banks are dumping treasuries and only going to gold, it's really it's overblown. That's being a
No,
bit
and
histrionic, correct?
central banks, for the most part, are patient buyers, but they're also noteworthy, not very price-sensitive buyers, right? Once they have made up their mind, they'll
Right.
do it.
They come in with
And
their checkbook.
so I think it's a very important component, but anybody who jumps to conclusions is that it's mostly just feeding your own narrative. And of course, I have my own confirmation bias as well when I look at these things, but I like to keep an open mind in these things, and I just consider them but one of the factors. It's a very important factor.
Yeah. Okay. Similar thing here. Johnny asks, how can gold go down when the U.S. is collapsing? And he puts a little crazy emoticon there, so maybe it's a little tongue in cheek.
Extended boom, people use leverage, and when you de-lever, anything can go down. Now, that said, when you have a risk-off environment, often the dollar actually rallies because it's a short squeeze. When emerging markets borrow in US dollars, it's a short on the dollar, and when you have a quote-unquote collapse, that would be a short squeeze on the dollar. But yes, it can be, because in an overall liquidation, it can go down. It's usually and that would be a deflationary environment. It's just that central banks are not going to let it happen. And so it's in that follow-up move that when precious metals historically benefit.
Yeah. And I say this as a gold holder and a gold fan, but no asset goes up in a straight line unbroken. Any asset can appreciate in price faster than either fundamentals can demand or the market can absorb. And so there will always be pullbacks after an asset just runs too far too fast, right? Secondly, be careful tying this to a U.S. is collapsing narrative, right? I mean, gold can go up under kind of, the U.S. can still be here in 100 years, and gold could still go up for very valid reasons right now. But if your gold trade is predicated on the U.S. is going to, fail as a country in the next 5 years, and the dollar is going to lose world currency status, and no one's going to want to own our currency or hold our treasuries, that is a really big ask, and I think the odds of that are quite low. And that's to Axel's point. You just got to be careful about some of these narratives that are swinging around there. And look, again, I'm a gold fan. I do own gold to protect against future depreciation in purchasing power of the currency, but for me, it's not predicated on the U.S. becoming a failed state in 2 years.
Yes, and on that note, just before we wrap up, the Roman Empire took them hundreds of years of decline, right? And so just keep that in mind, that when things are quote unquote bad from one's perspective, it doesn't mean there is an end tomorrow. And what my framework is, that sand has been thrown into this machinery called exorbitant privilege. It's not like a kill switch, and trade does that because you're blocking the flow of goods, which means the flow of currency is there. And people say, oh, the dollar can't stop being the reserve currency because there's no alternative. My view is there's going to be increased fragmentation. There's no winner in that. There's only losers in that. Mm-hmm. And the final thing to say is, if there were a more extreme scenario, which I certainly don't rule out, keep in mind that policymakers will change the rules of the game.
Exactly.
So you might have the perfect answer, and then the rules change. And so just be aware of that. And let's say, and obviously we don't know exactly what that's going to be, but finally, policymakers are superb can kickers. They can kick the can down the road, and the U.S. with its depth of resources is probably a better can kicker than many other countries.
Yeah, maybe almost every other. And Brent Johnson talks about this a lot, which is, look, there's just so many cards the U.S. has left to play that it hasn't. And you always have to ask yourself too, like, okay, so if the U.S. isn't, if it's going to get supplanted by whom, right? And you look around right now, there's not a lot of great alternatives. But I try to remind people of the Star Wars trilogy series, right? You had A New Hope, where they blew up the Death Star. Then what happened, right? The Empire struck back, right? It's not just going to roll over. The U.S. is just not going to give up. There's a lot of things it can do to protect its extraordinary privilege, and it will want to. So again, just be mindful of all this. And again, I say this as somebody who thinks in the long arc, fiat currency, including the dollar, is going to lose its purchasing power. There's lots of great reasons to buy this stuff. Just be very careful about putting all your chips on a very low tail event happening very soon. With that, Axel, I know I got to let you go. Real quick, for folks that want to follow you and your work in between now and the next time you come here, where should they go?
merkinvestments.com is our corporate website and a free newsletter. We have our gold and gold mining products. You can links from there. I can't discuss them here. At Axel Merk is my Twitter handle, where I talk about monetary policy and all kinds of interesting things.
All right, fantastic. And if you want to get some help from a professional financial advisor in navigating these the road ahead here, market-wise, feel free to talk to one of the firms that Thoughtful Money endorses to do that. You can just fill out that very short form there at thoughtfulmoney.com. And since we've talked so much about gold, if you would like to better understand the options for buying and storing gold and silver, feel free to read our free guide at thoughtfulmoney.com/gold. Axel, my friend, thanks so much for doing this. Folks, if you enjoyed this, please let Axel know in the live chat, or if you're watching the replay, in the comment section below. And if you want us to keep doing this in the future, let us know that, because we always want to keep doing more of what you want to see us do and less of what you don't want to see us do. But Axel, my friend, this is such a privilege. Thanks so much for continuing to share your thoughts every FOMC release with this audience.
It's great. Thanks. Yeah, take care.
All right, and everybody else, thanks so much for watching.